We're going to take a look here at Apple stock, at buying calls. If we think the price of the stock is going to go up, one thing we can do is we can buy calls. That'll increase our leverage, and it'll also help us if we wanted to get long. Instead of buying 100 shares of Apple for $254 each, $25,400, what we can do is we can buy one option. Okay, so we're going to take a look at buying a call and see how that would work. What we're looking at here on the chart, first of all, is we want to determine where our target is and where our stop would be. Okay, in this case, maybe we think the stock popped through the 200-day moving average, this yellow line here today. Maybe we think, okay, if it falls back below today's low, then we're wrong about the trade, and we should exit there. So we're going to put our stop here. It's 244.30. We'll put our stop at 244. To the upside, there's a bunch of things we could look at. We could be looking at filling this gap here at 310.50. There's a gap in the price here. We could be looking at the highs around 328 right there, or we could just be looking at maybe we look at the 50-day moving average. We think it'll get through this 20, but it might find some resistance at the 50. So basically what we're looking at here is about $50 of upside, and $40 of upside and about $10 downside. So we've got a 4-to-1 ratio risk reward. Seems pretty reasonable. So we're going to take a look at the options for that. Click here. Alright, so we've got Apple options. You can see we've got Apple. Price here is 254. That makes the 255s our at the money strike. I'm going to go with at the money. Another thing we want to look at is we need to choose our strike or our expiration date. May 15th has 51 days remaining. April options right now have just 23 days. What they're going to start to see is some theta, some time decay. To avoid that, I'm going to go a little farther out. Generally around 20 days, we're going to start seeing an acceleration of time decay. So I tend to like staying about at least a month out. And in this case, the next monthly options are 51 days. By monthly options, I mean the options that expire on the third Friday of a month. This is kind of a leftover term from the old days in trading when options only had expirations once a month, and that was the third Friday. Nowadays, we have weekly expirations. I tend to like to stick to the monthlies because they tend to have higher volume, and they're more liquid and have tighter bid-ask spreads. So we're going to go with the May 15th. That's 51 days out. I'm going to just buy the at the money strike, 255. Okay, we can also calculate what our risk is here. So we're looking at, we said 244 was our stop. That's $10 lower from here. Okay, we can look at our delta. Multiply $10 by 54.54 delta. That gives us $5.40. That's how much we can expect our option to move, more or less, if the stock were to drop $10. Okay, $5.40 on a $21 option. That's 20 to 25% is our max risk. When I say max, of course the stock could gap lower and fly right through our stop, but assuming it doesn't do that and then it just goes down slowly and hits our stop, that would be our risk for this option. Okay, our max possible risk, of course, is the full amount, $21.50. That's what we're paying for it. That's $2,150. That's our max possible risk. But that's only if you let this go all the way to zero. You don't stick to a stop, or the company goes bankrupt or whatever. But Apple's not going to do that. So our risk is about 25% of our premium paid. So we're paying $2,150. And we're saying our risk is roughly, I said $540, 54 cents times the $10. Okay, so that's our risk. Our upside, we said, was about 4 times higher, so we're looking at considerable upside. So, okay, so I'm going to go ahead and buy that. I'll just buy one here. We're looking at buying it at 21.40. I'm going to go ahead and I'll just buy it at 21.35. We'll see if they hit us. You can look here. You can see their max profit and loss. Max profit is infinity. Max loss is the full premium that you're paying. Okay, send that. All right, so we're right now. I just bid 21.35. You can see that's sitting here right now. 21.35 is the bid. Nope, now it's 21.45. You can see the price of the stock is actually ticking up a little bit. Okay, so we're not getting hit on the 21.35 bid right now. We'll see if it drops down a little bit and see if it can hit us. And of course, as I'm doing this example, then it would run away from us. Let's see. Okay, in this case, what we can do, you can always go back in, you can edit it. If you can decide if you wanted to pay up a little bit for it or not, you know. So, anyways, that's really all there is to it for purchasing. I'm gonna clear out of that. And actually, I'm just gonna go ahead and cancel the order. This was just an example. I don't need to make that trade. And that's it. That's how you buy a call. Those are the kind of things you run through. You're going to look at the delta. You're going to make sure you have a stop in mind. In this case, we decided the low of the day was our stop. That would be 244, and then you can calculate your risk with the delta, and you can decide if that's a reasonable risk for you or not. Okay.
Thanks for watching, and don't forget to hit that subscribe button.